Very good afternoon to all the viewers who have joined this webinar on macro and equity outlook. So today we have Mr. Gopal Agrawal with us, who is our senior fund manager. He doesn't need any introduction, but still for the starters, at least I just should mention a few of the schemes that he manages. So Gopal manages our large and mid cap fund, our balanced advantage fund, and our dividend yield fund. So, as we shortly go ahead with the call, we'll discuss uh, his thoughts on equity markets, the macro view, and portfolio positioning as well. Before Gopalji, I hand it over to you. Just wanted to set a brief context. Is that last 1 or 2 years have been pretty eventful, both globally as well as domestic. Globally, we've seen wars being fought, the tariff being imposed on India and various other countries by the US, the emergence of AI, and the threat it has posed to various probably sectors that we see today. However, there have been a lot of good things in terms of the oil prices being kind of benign, so that has not posed a problem. Most of the macro indicators, I hope we'll hear from you in detail, but have been in control, be it the inflation, the fiscal deficit, the current account deficit. From an equity market point of view, we hope you touch upon mainly the valuations. There is this narrative that the valuations have moderated in the last 1 year, with the markets not having increased by a big margin. On the earnings side, also would like you to touch upon in terms of post-pandemic, there has been some jump we saw in earnings that has kind of come down a little bit. Consumption was an issue that was highlighted in terms of why the economy has probably what it could have done. A lot of government measures we have seen to address the problem of increasing consumption, including budgetary provisions, the GST cuts, etc. So there is also hopes on the revival of earnings as well. So FIIs have been kind of silent. There has been FII net outflow in the last few quarters. Probably it is at their holdings is at a low level. But India is also viewed as a market for a non-AI play from a FII point of view. How that point is going to play out. So a lot of interesting points we want you to touch upon. So with that, I'll hand it over to you, Gopalji. Uh, yeah, you may take
Sure,
over.
sure. Thank you, Ram, and good afternoon, everyone who have participated on this call. So, I'm Gopal. I'll take you through some thoughts on the market. So, just to set the context, our market is basically a slew of earnings, earning growth, liquidity, and interest rate. So, I will try to touch upon the various parameters. Yeah. So on the on the economy side, I'll just touch upon few parameters which is important. Is that currently, in the last couple of years, the government investment has lifted the boat. So our capex from the government has gone up from 3 lakh crores in FY21 to over 11 lakh crores. So, we have seen significant increase from the government on the investment side, and that is why majority of the investment related stock from FY21 to FY25 have done well. Now, what the market is seeing that the capex growth is around 10% from the government, and now with the GST cut which has been announced on August 15 and implemented from September 22, so there is a fear that central government capex can moderate, and like we are also seeing state government, you can see on the chart on the right hand side, the state government capex is already correcting a bit actually. So definitely that is why in the near term the investment is a question mark, and that is why these stocks which are related with investments are under pressure. While on the consumption side, definitely the bigger story in India is that we are a young population and median age is around 29. So definitely the consumption is here to stay, and discretionary consumption especially is increasing, and it has a very long way to go, especially next 10 to 15 years. We have a clear roadmap for big growth in discretionary consumption, health, wellness, tourism, travel, beauty. These are the things which are likely to do very well over time. In India, the good part is that the rural economy is likely to see better days because of good monsoon. Crop production is good. Government is supporting the prices through MSP, and also what has happened. Let's say there are various schemes announced by the government, and also like Latki Behna, and then what we have seen in Bihar election, 10,000 rupees to per women transfer, and so all this is really supporting the rural economy, and which is likely to do well in the times to come. Now, on the global context, very clearly, I would say we are in a period of real uncertainty, because what has happened, the US is doing well for themselves, because the AI-led spending on the tech side is increasing, but definitely there are a lot of uncertainty on the global growth side they have created by tariff. And you are seeing like European manufacturing industry is under tremendous pressure, and I would use the word is in a terrible condition. You are seeing what is happening with their auto sector, you are seeing with their chemical sector, and agrochemical, petrochemical. Every industry in Europe is in a very very difficult time at this point of time, and also in for the India's context, the tariff has been increased to 50% from August 27. So the real pain we have started just to see from September onward, and so definitely there are a lot of uncertainty. And on the China side, China is more balanced economy, I would say, in a way that they don't have much external borrowing. So whatever is there, their problem is inside the country on the debt to GDP side. But definitely Chinese growth has already moderated to 4.5%, and their target is to keep it there. So that they can create 10 million jobs per annum. That is their objective. But definitely Chinese growth has moderated, and it is likely to be like that. And the government will do all the heavy lifting to support the objective of 10 million jobs creation per annum there. So that is there. Now coming to to the our market side, very clearly market in India has withstood all the problems of tariff related thing. We have weathered this storm very well. It is being well supported by the government in terms of GST support, very good monsoon, and also whatever action RBI has taken with the new governor, coming on at the helm. We have seen like India's economy has really done well. We have seen our banking system liquidity, which was in deficit in December, January. RBI has injected liquidity through OMO. Now CRR cut has been done. They have reduced the risk weightage, and many things have been done so that the lending should take place in a big way in India, and that is why you are seeing credit growth has gradually picked up from 9% to now we are touching closer to 12% YOY credit growth. So definitely now things are stabilizing, and government in recent past has taken a lot of steps to support the export sector, which is under pressure because of tariff. So now on the market side, if you look at our valuation of the Nifty is around 20 times FY27. Okay, in this very heavy dispersion is there. The businesses which have the clearly the long-term visibility and which have a narrative of big growth are trading at a very high multiple between 50 to 100 P multiple, and the sectors which have question mark on the terminal value like power sector, like oil and gas, they are trading at a single digit P multiple. So the market has really, have given a lot of dispersion, and that is where we are. So, and these days, because of hedge fund activity and people's very short term memory, any data point which is positive is being rewarded, and anything which is negative in the near term are getting punished to a very low level. So this is what the market is turning out these days. India's premium to emerging market has really come down significantly. We are now closer to, or the long term average, and India's share of market cap has fallen 25% from the peak. Now on the mid cap side, I would say mid caps are still expensive to the large cap, but definitely they have come off from the peak. They have given 20% extra valuation as compared to the mid cap in the last 15 months. And but the best part is that the mid cap companies have better earning growth as compared to Nifty 50, and we have even seen in this quarter which gone by, the Nifty has a earning growth of 2%, while mid cap, though 150 mid cap stocks is not covered by most of the brokerages, but almost 110 where coverage are there, aggregate earning growth is closer to 10%. So still I would say the mid cap earning is good as compared to the large cap, and though valuations have moderated, so still I would say, though I'm not saying that it is cheap, but the valuations are high, but it is being supported by better earning growth. The biggest problem is in small cap. Small cap earning for the last 18 months is on a downward trajectory. We are still see, despite this, the valuation of small cap is on a higher side, and and it is still showing the pain. Let's say you have all the MFI, small finance bank, all are in small cap. We have seen some of these engineering related stock, Jal Jeevan Mission related, pipe related sector and all, right? All are in small cap, and is even in steel industry, small cap companies are under pressure. So we are seeing on an aggregate basis negative earning growth in small cap, and though there are always a pocket of a strong earning growth in small cap, but definitely as a basket they are showing still negative earning growth. That is why the small cap is underperforming to the market. Now I would like to share with you very interesting chart for all the participant here. If you look at, this is a very perfect inverse correlation between banking system liquidity and in the small cap performance. The upper chart is the banking system liquidity, which is in deficit. You see the small cap have underperformed between December to March, April, and as the new governor has come and the liquidity being injected in the system, you saw at the peak we had a 4 lakh plus crores of liquidity surplus in the system. You saw the small cap have started rallying. Now with the impact of tariff and everything, we have seen a period of again the liquidity turning to deficit, and now still liquidity is surplus in the near term, but our trade deficit is high. So that is why the small cap is going through the time correction. They are consolidating. But if so, what I am saying, if the liquidity turn positive, the growth comes back, and the small cap does well when the growth is high. And whenever the growth falters, you see small cap underperforming. So if the next thing to watch is the US trade deal with India, because if you see the October trade data, India had a $41 billion highest ever trade deficit, and we are also selling dollar to support currency. So if trade deal is signed, so it will give some support to the small cap performance, and if it is not, it can have some more impact on the small cap stock performance on the negative side in the times to come. Now I just touch upon the earning I have told you the Nifty earning grew by 2% this quarter, and in this quarter the maximum earning growth supported by in the Nifty 50 by oil and gas and metal sector, which has done extremely well. And X of oil and gas and Nifty earning was only grew by 1%. Right, you have seen very heavy dispersion in earning performance. Net I would say that non-ferrous metal oil and your OMCs have done significantly better. IT has not disappointed because the expectation was also very low. So the IT sector as a whole have not disappointed in this quarter. Actually, there were certain misses in earnings we have seen, especially from global autos and even in petrochemical industry has not done well. We are in almost 15 years low in terms of profitability into the petrochemical industry. So, and because of heavy monsoon, power demand growth in India was -7%, till 1st April to October 2025. So that is why the power related and coal have underperformed in this period. And so because of heavy monsoon, hopefully things should revive from here. Now, net, what I am saying that we have seen the banking and financial sector has reported decent earning, especially by the public sector banks, and then in private sector also they have defended the margins very well because of a repo rate cut, and there was fear that margins will be under tremendous pressure, but the sector has protected it well. So that is why so that is why this sector is doing relatively better in the market. Now, as I told you, small cap, large cap, and mid cap earning. So large cap earning grew by Nifty grew by 2%, while top 100 grew by 7%. Mid cap earning was by 10%, and small cap had a earning decline of 5%. So that is the broad spectrum of earning in the near term. So I just want to share with you one chart on capex. Capex is now moderating in India except the power sector. If you look at commodities sector, which is listed space, is showing you -7% capex growth, and power is plus 19%, consumer including auto is plus 9%, even telecom has reduced their capex, right? So net we are seeing only 4% capex growth in India as compared to in FY25 we saw 12% capex growth. So that is why the capex related stock, power related stocks have now underperforming in the market. So that is the reason, and if we only hope now with improvement in profitability, especially by the non-ferrous metal and refining sector, we may see better days to be there in terms of capex. Now, on the sectoral side, I would say in the near term, market is pricing in good growth in the consumer discretionary sector after the GST cut, especially autos. Though market is ignoring the near term result because of after GST announcement from August 15 to end of September, sales were quite muted, and because it is likely so because people were are expecting GST rate to be moderated. So market is looking at good recovery in Q3 and Q4. So and that is accordingly the auto stocks have really outperformed the market very handsomely. So we have to see now how the earnings pan out. Now stocks are priced to perfection. If any disappointment in earnings in Q3 and Q4 come, it can correct meaningfully because now there is no room for error in their valuation. I would only say that now power sector has underperformed because of -7% power demand because of very heavy monsoon. And if the revival in demand comes, this is a sector which can recover from the very poor performance in the last couple of months actually. IT sector had seen the worst of the time because of Trump tariff related uncertainty, and lot of question mark on AI and its impact on the IT sector. Though I am not saying like this sector is going to do extremely well, but from the 0 to 2% growth, we can go back to 4 to 5% growth based on the various commentary by the various management. So there can be some stability in this sector can emerge in the times to come. On the healthcare side, definitely we had a great years of FY 23, 24 and 25 in the pharma sector in terms of earning. Now, because of a specific drug related issue and other thing, earnings is likely to be moderating in FY 26 and 27. So this sector is going through some time correction, though the outlook for medium term to long term is very positive. So that is there. Consumer discretionary is definitely likely to do well over years because of young population in India, and the consumer habit on spending is changing. That is net which is there. On the metals and mining side, I would only say that we need to give some support to steel industry. Otherwise, the way cost structure in the world has come down and there are excess capacity, so this can come under pressure. And what the news is coming, the small scale industry in steel sector is already under pressure because demand was muted because of very heavy monsoon in India, and also cheap imports, especially in long product. There was no import duty protection was there. So we need some kind of protection, otherwise this sector can create another problem. The good part is that the non-ferrous is doing extremely well, and it is being supported. Though I would say that the prices have reached to a very high level, and from here onward, I really see. Unless there is a good demand revival, I really feel that commodity prices are at a level where I don't see meaningful upside from here actually. Right, so that is there. I am very positive on the refining cycle because hardly any capacity is coming, and the way Russia, which used to export diesel especially to Europe, is now going off the market. So so definitely it has certain impact, positive impact on the refining cycle in the years to come. I would say, let's say our commodity chemical industry is in a better shape because Europeans' cost structures have gone up, and so we have relative advantage, and I am very positive on certain specialty chemicals because Chinese are not there in to that extent. So that segment or on a aggregate basis, I feel they are well positioned. Now coming to the sectoral performance, IT has lost the biggest weight in the sector. FMCG weight is the lowest. Capital good had gone up. Now this sector is in the last couple of quarters. As I told you, government did all the heavy lifting for the last 5 years, so that is why it has done well. Now capital goods sector, as I told you, now will go through the consolidation because government capex is likely to grow by 10%, or it can be under pressure because of GST cut. Now, on the earning side, I would really tell you we had a 1012 EPS for Nifty for FY25. This year, first quarter was 4%, second quarter is 2%. So even so, this if there is a recovery in Q3 and Q4 thanks to GST cut and everything, we are likely to close the year with 7% earning growth this year. And even if I take 19% earning growth for FY27, we will end up with closer to 1300 EPS based on various brokerages for FY27. So the market has already pricing in a recovery very well. So from here onward, we can at best make return in line with the earning growth, the compounding return here onward. That is the view I have actually. Now, some negative on the market is continuous PE selling and promoter profit booking. So that is taking away the money from the secondary market activity, and that is why you are seeing very these days, anything which is not performing, people the if any earning disappointment is there, the stock price performance is very dramatic. So there is no patience these days because of less and less money is available for secondary market, as a lot of money is going for primary market. Now, on the global side, I would say US market at 6850 has S&P 500 has already 260 is the EPS for from the Bloomberg consensus for CY26. So market is already trading at premium to long term average, and also 3% premium to Indian equity market. So now at 6850 S&P 500, there can be some consolidation, moderation. I don't know exactly, but the global market can go through some consolidation or some correction based on how the earnings pans out in the times to come, because at multiple which is closer to 23 times or so. So for a potential GDP growth of US 2%, 10-year GSEC is at 4% plus. So there is hardly any room for an error in this valuation. So you have to be little cautious on the global side. Some bad news can come if earnings don't match up with the expectation. So now net I would say in India we have weathered this problem of tariff very well. RBI has done a lot of good works in the last 6 to 9 months. Liquidity in the system is still surplus. That is positive, but we have to watch out for the US India tariff, because our export is now is slowing down, and so if things don't turn well for us, then continuous FPI selling and PE selling can lead to dollar shortage in the system, and it can have its own impact on the bond yield and the liquidity. So that side I am little watchful. I don't have any view. I am just sharing with you what to look for. So the impact of 50% tariff has just started from September onward, I would say. So it's early days. So we have to see, early conclusion of the deal is very, very important for our market, especially small cap sector performance. So now I will take you through my funds. So on the HDFC Balance Advantage Fund, so this fund now we are running, as I speak to you, around 64% net long equity. It is primarily because of market gain. we brought it down equity to 49%, and then in March April I took it to around 55%. And because when the valuation became attractive, but because of M2M, and we have reached to around 64% this stock equity at this point of time, and remaining is we have 2% of REIT InvIT, and then we have some arbitrage, and 30% is managed independently by our fixed income team actually. So that is there. And if you look at we have made now 80% large cap and 20% is mid and small in our fund. So earlier it used to be like very heavy small cap mid cap fund. So now we are 80% large cap and 20% mid and small as I speak to you. And if you look at performance since I'm managing, though 1 year, 5 year, 10 year is all performance is there in our HDFC website. You can refer to it. But since I'm managing, I've generated 19.4% compounding return, and beaten the benchmark by over 8% compounding during this period. And what I can tell you, in this fund we have huge surplus to pay off dividend regularly, because we had booked a huge profit in August September 2024. Now, in large and mid cap fund, in this fund is for very aggressive equity investor. But as I told you, mid cap outlook is mid cap valuations are high, but they are supported by very high earning growth. So large and mid is very good for if you have the long term horizon to participate in Indian equity market. I am always a votary of mid cap, because my learning in the market is that whenever a company crosses 200 crores of operating profit in size, their fear of collapsing reduces. They are in the best J curve of growth, and so that is why we should that is my personal view, no official view. The best way to play Indian equity market for 10-15 years is the large and mid cap fund. So in this fund, we are overweight on healthcare, IT, and rest other is almost equal weight. Consumer staple, energy, industrial, I am underweight. So that's a positioning of the fund. In this fund, we have alpha of around 2% since I am managing this fund, and now this fund is closer to 28,800 crores in size. Now, third fund is dividend yield fund. This fund is very different than I manage to other fund. This fund is for primarily a conservative equity investor, and because this fund is focusing on generating dividend, so IT sector pays off very high dividend. Over 4% dividend yield is there. So I am overweight there. Consumers, communication service, industrial, especially I have certain companies with high dividend. So that is there. So it's a very different than normal. So what one can do, one can buy some diversified fund, some flexi cap fund and all, but can complement by dividend yield, because most of the funds run overweight on financials and underweight in IT. So this is a contra. So I would say it's an ideal fit for a contra kind of investing in the fund. And if you look at the performance, we have generated 21.2% CAGR return since NFO of the fund, and we have beaten the benchmark by closer to 3.7%.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.